This segment, we're going to talk about how to borrow money. There are basically two ways. One way is you can borrow the principal, and then when you repay both the principal and the interest on the loan. And that's sometimes called a straight loan, or borrowing principal and then you repay the principal and the interest. The other way is you borrow, you sign a note, but they give you less money up front, and that's called a discounted note. And a discounted note means that when you repay it, all you repay is the amount of the note, or the principal of the note, because the interest has already been taken out. So let's take a look at an example of each of these and then do a problem. On the last day of the month, we borrow $120,000. It's a 60-day 11% note. Notice that the interest is not included in the face, meaning when we get ready to repay it, we'll repay both the principal and the interest on the note. So on 10/31, when we borrow the money, we will be debiting cash and crediting note payable, or short-term note payable, for the principal or the face amount of the note, $120,000. At the end of November, which is the end of the year, which is November 30th, we need to make an adjusting journal entry to accrue the interest, because the interest clock has been ticking since October 31st. We need to recognize the liability, or the promise, that we will repay this interest. So we'll debit interest expense, credit interest payable. The amount of the interest is computed by taking the principal, the $120,000, times the interest rate, 11%, and 1 month, or 1/12, has passed, and so the amount of the interest that has accrued is $1,100. When this note comes due on December 30th, which is 60 days after you borrow it, you're going to debit interest expense for December's interest of $1,100, because 30 days have passed since you've accrued it. You're going to debit interest payable to pay the interest from November. Remember that adjusting journal entry for $1,100. You are going to debit note payable, or short-term note payable, for $120,000, which is the principal, and you're going to credit cash, because remember, we're repaying the note plus the interest. So that's $122,200. Compare this method, principal plus interest, with the following. Same problem, but interest is included in the face of the note. So when we borrow the money on October 31st, we're going to be debiting cash and crediting note payable. The note payable will be for the $120,000, but the cash will be for $120,000 minus 60 days worth of interest, which remember is $120,000 times the interest rate of 11% for 2/12, 60 days or 2 months. So the amount of cash that you're going to receive is only $117,800. So we'll need another debit, and we can't call it interest yet because we haven't used the money. So what we call it instead is discount for $2,200. So that's how we borrow it. On 11/30, when we need to accrue the interest at year end, we're going to debit interest expense. But now, since we've already prepaid that interest, and it's sitting there in the discount account or discount on note payable, it'll be for 1 month or $1,100. And you'll remember that I got that number by taking the principal times the interest rate times the time that has passed, which is 1/12. When we get ready to repay the note on 12/30, 60 days later, we're going to transform the rest of that discount into interest. So there's December's interest, and we're going to pay back the note. And to pay back the note, we're going to debit note payable for $120,000 and credit cash for $120,000. So I've paid back the principal and converted that discount, the prepaid interest, into interest expense. Well, let's take a look at one more problem. Here we have a note, and notice we have a face of the note of $20,000, but we're only receiving $19,250 for a 90-day note at 15%. So when I borrow the money, I receive cash of $19,250, but I'm going to credit a note payable for $20,000. The $750 difference is the discount or the interest that I'm paying in advance of using the money. Now, on December 31st, we're going to have an adjusting journal entry, and that adjusting journal entry is going to be debit interest expense and credit discount as we convert the discount into interest because we've used the resources. So how much have we used? Well, the principal of the note, the face amount of the note is $20,000. The interest rate is 15%, and 1/12 has passed, or $250. The second part of this is show how the note would be disclosed on the balance sheet. Well, in the current liabilities section, we would show note payable for $20,000 less the discount that remains. Notice we started at $750. We've converted $250, so the discount that remains is $500 at end of the year. So the note's going to show up on our books at $19,500. Well, here's the interesting part. It says compute the actual annual interest rate on the note. Well, we paid $750 for the use of this money, or for the loan, but we only got to use $19,250. So if I find the number, it's 0.38961, which is for 90 days. Interest rates are always reported in terms of a year, so there's 4 90-day periods in a year. So the true interest rate is 15.58%. Contrast that with how that interest of $750 was computed. It was computed based on a loan of $20,000, which does give us for 90 days, 0.0375 times 4 90-day periods in a year, or 15%. So what is the true interest rate? 15.858, which is a higher interest rate than the stated rate of 15%. Well, why? The reason is that you're paying interest on a larger number than you're actually having access to. So that's how they get their profit up front, by offering you a discounted note, and making sure that you pay a higher interest rate as well.